I'm Chris Preston.
And I'm Brett Simmerman.
Welcome to Street Check, the best three-person podcast in the history of Cabot Wealth Network. As those of you on YouTube can see, we're opening up with Jacob Mintz, our options extraordinaire, who we're going to talk to in just a second. Jacob's will be the first of several Cabot guests today. We're doing our sort of quarterly round the horn just to take the market's temperature from a variety of different angles. Jacob, I know you really want to talk Fed and jobs report, since those are your favorite parts of Street Check as our biggest fan slash ombudsman. But we'll settle for options. I'm curious. September famously is the worst month for stocks. This first week, after a rough start, is stabilized. It's been fine. What is the options market telling you right now?
That's actually a really good question, Chris, and I'm writing about that this weekend in my Monday weekly review. The options market, despite the stock market breaking out to new highs, the options market's been pretty quiet to mixed for the last couple of weeks, which is kind of signaling that the big hedge funds and institutions aren't fully committed to this market advance.
Mhm.
Typically, I would see a lot of big call buying in the market leaders. I don't know, maybe like a Palantir or Nvidia or stocks like that, and I am not seeing that, it's not time to panic by any stretch of the imagination, but it's also saying the the options traders, the big hedge funds, and institutions aren't big believers in this rally just yet.
Is there anywhere where they are stepping in with size at all?
No, not really, to be honest. It's a lot of one-offs. There'll be a buyer of CSX, the railroad company, and then there'll be a buyer of it's just kind of all over the place. It's scattershot. It really just depends on the mood of the market every single day, that just keeps changing. One day it's an AI day, so there'll be big AI call buying, and then the next day it'll switch to like the Russell and smaller stocks. So there's not been a lot of consistent buying over and over again, which is what I'm looking for when I'm buying positions. And I've actually kind of pulled back on buying. We bought a position for Cabot Australia last week, but this week, even as the market's been ramping higher up until today, it's we've kind of just been staying on the sidelines watching the situation play itself out.
Yeah, I mean, Mike Santolo, our market timing and growth expert, has talked about he's seeing rotation, basically sort of classic rotation. I guess defensive stocks haven't participated much. I mean, are you seeing in like gold and silver? We're gonna have Clif Droke on right behind you, or at all-time highs or decade plus highs now. Are you seeing a ton in gold and silver plays, or is that also inconsistent?
To be honest, I generally don't watch that group too
Yeah.
closely. I've just never understood when going to go up, when silver's going to go up. Sometimes it's a defensive play, sometimes it's an inflation play, sometimes it's just so I've kind of just not really focused too much on that. I will say, just in terms of going back to the options world, if I want to be positive about the market, and I am generally positive, the the VIX has been trading around like 14, 15, 16, which is kind of like my sweet spot of sorts. If it was, trading at 12 or 13, I'd be like, we're probably getting a little too complacent. If I was trading at 20 or above, I'd be starting to perhaps pare back some of our positioning. But 15 area approximately kind of says the big hedge funds and institutions, while they're not necessarily believing in the market's advance via call options, they're not necessarily rushing to buy protection against a market decline. So maybe we're just kind of, stuck in a neutral zone for a little bit, or at least, we have the Fed meeting coming up soonish. So maybe we'll get through that and then things will start ramping again.
So you have, you were on the CBOE, you've traded with like the big boys. If you had to speculate, is it valuations or is it seasonality that has them maybe a little bit on the sidelines, or the big money being on the sidelines a little bit right now?
Right. I don't know, to be perfectly honest. I'm saying a lot. I'm speaking out of both sides of my mouth a lot today. I'll just say this in terms of vibes. Let's just go there. There's a couple negatives I'm seeing. You know, stocks. We'll talk about again about the leaders. Palantir has not been participating in the market's advances, kind of getting hit today, kind of getting close to retesting its recent lows. Nvidia's pulled back since its big earnings breakout. The market kind of the market gap today. higher on the jobs report and then has pulled back since. Now, who knows by the time you're listening to this podcast, where it'll be. But I just wonder if we had a buy the rumor of sorts of the Fed cutting interest rates.
Mhm.
And now that it's pretty much a slam dunk, the Fed's going to cut interest rates. Maybe it's going to be sell the news type of time. So we'll see if that actually plays out. But that's kind of, bubbling in my mind that, we saw that we ran into the Fed. It's now a slam dunk. There is going to be a Fed rate cut, and now maybe we sell into that news.
Yeah, it's just the reaction to jobs report this time. I feel like the last time, I guess in July when the reports were really bad, there's initial sell off, but then sort of came roaring back like, oh, that means the Fed will probably start cutting rates now. And this time it almost feels, you're right, it almost feels a little bit more like we already knew that the Fed was going to cut rates this month based on what Powell said a couple weeks ago. Now we just have a bad jobs market, and
Yeah.
we need this to happen before we can get too excited about things.
Yeah, and just one more negative, I guess, if I were to say, or at least not uber bullish. Regional banks and housing stocks are not going to lead this market higher, or I don't think it will. So we're going to need some leadership from, I don't know, the big banks, which are actually under a ton of pressure today, perhaps on recession fears. We're going to need to see some tech kind of getting gear. Now, Broadcom, symbol AVGO, popped on earnings earlier today. And if I were going to be bullish, there's a lot of stocks that look great, and it's not necessarily the Palantirs; it's the second tier stocks of sorts. CRDO, Credo, an AI type of play popped higher this week. Sienna, symbol CIEN, surged higher. I have a long list of stocks that are on my watch list, like just about as long of a list as I can remember from this earnings season. It's just we need the market itself to get in gear, like fully in gear, for me to start really pulling the trigger. But there are a lot of stocks that are setting up nicely if we can get going.
Yeah, it seems like those sort of further down the food chain, like the AI infrastructure play. I think GEV was like a big institutional way to play, like the build out of data centers. That I think is taking a little bit of a haircut today.
Yeah.
It seems like what we're seeing is like you said, the second order beneficiaries of the data build out. So it's still the AI trade. It's just it seems like big money is sort of out of the first layer of it.
Yep, I would agree. There's I messaged fellow Cabot analyst Tyler Long, and there's my list is so long, but it's just such a diverse list of stocks that weren't really even a thing 6 months, a year ago. I just said to him, I just figuring out where all of these AI plays kind of fit in is a struggle. It's no longer you see a stock like you don't just see the railroads and the banks and the airlines. Now it's third derivative AI data, whatever coolant. So it's just definitely become an interesting market in terms of finding where keeping the portfolio diversified because you don't want too much AI exposure in case that story ends. But that is the group that's working. So it's a tough market. There's no question about that, especially with all the quick rotation these days.
Last question. What are your hopes and dreams and expectations for the Bears this season as a
Oh,
Chicago?
God. I've been burned way too many times to have any faith in the Chicago Bears, but I'm gonna take the Cabot line when the market gets a little soft. I'm cautiously optimistic about the Chicago Bears this fall and winter.
Yeah, your crystal ball is broken.
Yeah, that too.
We're in the shop. Jacob, thanks for joining us, and let's hope that the options market tips his hand pretty soon here.
Yep.
Yeah, thanks for coming on.
Thanks, guys.
All right, our next guest is Clif Droke, who is chief analyst of our Cabot turnaround letter and a gold and silver expert, which is the first reason we wanted to have you on today. Clif, you're on here maybe 2-3 months ago, and you said you thought gold was headed to 4,000 an ounce. It was already close to record territory then. I don't know, it was low 3,000s. It's now up above 3,600. It seems like it is destined for 4,000 an ounce. I'll give you a chance to do a victory lap, but why are we seeing such force in gold? And I guess what made you think that then? What makes you think it still could go higher now?
Well, at this point, this is not your typical everyday momentum trade. It's not necessarily just speculative buying, although I'm sure there's some of that. I like to couch it in these terms at the risk of sounding like a survivalist or a conspiracy theorist. I think this is gold for survival. This is literally people are of all socioeconomic strata, from the institutional investor down to the, I guess, smaller trader or investor, are buying gold because they realize it's dawning on people. We've got a structural inflation problem, and the inflation is not going to abate on, certainly not on the retail level, and that's part of the inflation driven aspect of it. Asset preservation is key right now, and I think that's what's driving gold more than anything. There are other factors, of course, but I think asset preservation is what it's all about at this point.
So to your point with that, um, 3 days ago, it looks like gold surpassed treasuries as far as being a central bank reserve asset for the first time in 30 years. So
Wow.
it's not, this is not just retail investors like, well, no, I'd rather have gold than cash, or I'd rather have gold than bonds or whatever. Like central banks are actively buying gold right now, and they're eschewing other currencies. And obviously there's political conditions that are sort of forcing that play as well. But I agree with you. I am bullish on gold, that's the sound of the death knell ringing, of course. Um, how how high do you think gold can go? I'm entirely putting you on the spot here, and I recognize that.
Uh,
But
well, normally I'm pretty reticent about making price predictions about anything, but I'll say it. I think we'll see $10,000 gold eventually.
Ooh.
Yeah,
Oh,
why not? Uh,
wow.
I think we'll see. I'm not the only one. I believe Goldman Sachs, one of the big institutional banks, is saying they think gold could hit 5,000 by the end of this year. If I read that correct, they said 5,000. I thought they said by the end of this year. That might be a stretch. I definitely see 5,000 in the next several months. And
yeah,
Wow.
a week ago on this podcast, we do our defend the take, right? A week ago, my take was, hey, gold's up 10%. Gold's got at least 10% ahead of it immediately. Um, it's up 4% since that. But two-year
We need to
gold,
bring Cliff on for hotter takes than that one.
so to your point, I've been looking at this for an article that I'm working on in April of 1978. So the last time we had second wave inflation, when we were in the stagflationary environment, gold was $170 an ounce. It tripled in the next 2 years to hit 519. It more than tripled, but 2 years later, it was triple the price at 519 an ounce. That puts gold at 10,000.
that's a good perspective. Um, I can see, just from a strictly technical standpoint, whenever you see a major index or an asset reach 5,000, 10,000 is in reach. I mean, we saw it we've seen it with other assets, and um, you know, it's a technical, more of a technical call than anything, but gold is taking on a life of its own, and I believe it's coming back. I believe as a monetary asset in many circles, and that alone is going to give it a long term, tailwind. And I I just, there's talk of revaluing. I mean, basically, I think the sky's the limit for gold. And here's the thing.
Is
Oh, go ahead. I'm sorry, Brad.
No, no, no. I stepped on you.
Well, as far as you're saying, well, we're top ticking gold, right? Well, here's the thing. If you look at premiums for spot prices for gold and silver right now, what you would pay for if you were buying gold and silver bullion or coins, it's not that much. I mean, they've actually come down because what happens is in a Republican presidential administration, people don't get as personal survival minded, like we're stashing on, gold and silver. And we've seen that under Democrat for whatever reason, like when a Democrat comes into office, gun sales go up, gold and silver sales go up on the retail level. Well, we're not seeing that this time. We're not seeing gold and silver bullion sales quite as much as you might think, given the runaway prices. So that tells me that the smaller retail investor slash trader is not fully participating, which tells me that bullish sentiment hasn't fully peaked yet. I think short to intermediate term, that leaves more upside for gold.
And one thing you wrote about a few months back was how rare it is for gold prices and stock prices to rise in tandem, or to rise or fall in tandem. At some point, usually one of the two has to falter. So it sounds like, you're very bullish on gold. Are you not as bullish on the market then? Are you concerned about the market because of the bullishness in gold?
No, certainly not short to intermediate term. I don't have any immediate concerns about equities. I frankly, at this point, if my long-term thesis is correct and inflation is structural and we're stuck with it for years and years, I don't see why stocks and gold cannot continue rising in tandem. I believe at this point the equity market could be becoming something of an inflation safe haven, if you will, in itself. We've seen that in other countries when you get runaway inflation.
Said the same thing last week. This guy's a genius. This is why I love Clif. All right. So while we're on the gold, maybe speculative train, could we see a major currency repeg to gold?
Yes. It will, as far as which country would be the most likely to go first. I'd obviously, a foreign country, it's not going to be the United States, but it's being talked about. So yes, I believe it will happen eventually. De-dollarization is growing as a global trend, and something has to take its place.
Part of what prompted that is we're seeing structural economic weakness amongst all kinds of developed countries. Japan's 30-year bonds are at all-time highs. France is talking about, there's conversation about IMF bailouts. Germany's this is not a US problem. When you say structural, this seems to be a structural problem with just turning on the money machine and printing fire hoses worth of dollars. And I don't know, the first country to peg the value to gold becomes the reserve currency. I don't know. That's a bridge too far. I don't want to speculate that far, but
well, to rebound off a point you just made about printing, essentially printing too much money, that obviously is a big part of the inflation equation. But I'm actually looking at more of, when I think of maybe the term I'm looking for is secular inflation. I think a big part of the problem is as governments around the world become more, dare I say, autocratic, they're beginning to meddle with supply chains, as we've seen in recent years, right? That is having a big impact on inflation, because when you start doing that, the reason the United States was able to escape inflation for the better part of 40 years, despite the constant government printing, is because the private sector was strong and growing, and the government could never outprint the growth of the private sector as far as products and services being created. Well, that's not so much the case anymore. A lot of businesses are gone, especially smaller businesses, and they're not producing as much. Wars around the world are mucking up the supply chain as well. So that is another part of the equation that I don't think is going to go away. The governments have a tendency to mess, whether they mean to or not, they're messing up the supply chain, and that's feeding into inflation as much as money printing.
And not to be outdone, silver prices are at their highest point in more than a decade. Is it similar reasons, or is it something else behind the silver trade right now?
Silver, it's a valuation, undervaluation. People are recognizing that gold is getting pretty expensive for a lot of people, so they figure, well, the gold silver ratio favors silver. I think some of it is just value trade. Silver was just added to the U.S. Strategic Minerals list, and that's going to put, I think, another support behind the price. People are recognizing that silver is a critical metal for the alternate energy transition. There's a lot of fundamental factors behind it, but at this point, I think it's just silver is the sister metal for gold, and it's following gold's lead at this point.
Last question. Really, it's more a comment from your issue this morning, Cabot turnaround letter issue this morning. Very good stuff. But you took a shot at that hurt my feelings. Yeah, I'm a chai drinker, and you said writing about Starbucks, hard for me to get enthused over the company's latest efforts at promoting such offerings as flavored protein, cold foam, coconut water-based beverages, and iced chais. No, I don't drink iced chai. I think iced chai is actually really bad, but man, you hurt my feelings with that there.
I apologize. I'm a classic coffee drinker. I just
Yeah, most people are. Yeah, this is
Yeah.
my cross to bear. Actually, it's not a cross to bear. It's delicious. But anyway, just figured I'd point that out. But, Clif, thanks for joining us. I love the hot takes on gold, and they put Brad's to shame from last week. And yeah, we'll talk to you again soon.
appreciate it, guys.
All right, we welcome on our third and final guest of today's episode, Tom Hutchinson, who is Chief Analyst of Cabot Dividend Investor and Cabot Income Advisor. Tom, interesting time for the market. Interesting, and I would think good time to be a dividend investor. You know, September, as you pointed out in your issues, is always, I mean, historically the worst month for the market. But you know, we have the Fed presumably, especially after today's jobs report, slashing rates coming before the month's end. Where do you see the market? Are you, I guess, do you have any concern level right now, especially now that we're still at all-time or near all-time highs, or are you still pretty bullish? What's your perspective right now?
Well, I'm pretty good over the course of the rest of the year. September, I don't know. You know, like you said, we are teetering around the high. Investors are always cranky in September. So, you know, you could get whipped around a little bit this month. As far as the overall market is concerned, it's going to go where technology goes because that's such a big part of it. The AI rally was sort of sputtering, but they got a big positive report from Broadcom that could keep it alive. But I mean, I think technology will determine the index, but a lot of sectors, especially in the dividend realm, are much more concerned with what the Fed does, and are going to be very happy if the Fed starts cutting rates, and the more aggressively, the better.
Yeah, to that point, I mean, today's jobs report seems to have cemented a rate cut in September, and maybe we get as much as 50 basis points. So presumably we would expect stocks offering a decent dividend yield to outperform the broader markets, at least while the Fed is coming. I mean, is that sort of your bull thesis for some of the dividend pairs?
Yeah, it is. I think you know, the economy's got to be just right. You know, it's got to be lame enough so that the Fed is encouraged to cut rates a couple times maybe, or 50 basis points, but not so weak that the market starts worrying about the economy and earnings. So as long as it's in that area, I think a lot of these dividend stocks, and particularly in more interest rate sensitive areas, which have underperformed, have a chance to do very well.
Are there sectors that you have an eye on, or that you're higher on right now than others?
Yeah, well, I mean, the obvious choices with interest rates, REITs,
Yep.
utilities, although utilities are sort of on their own schedule now because of all the surge in electricity demand. So they're a little better than usual outside their normal, you know, pocket.
They're like growth stocks now in a way. Yeah.
It's great. Yeah, they're safe and growth, and yeah, they're one of my favorite places to be. But also the stocks that have a sensitivity to the housing market have been moving higher because, you know, the housing market, there's way more demand than supply. It could boom, but rates have been so peskily high, mortgage rates. If they start coming down, you'll see like Toll Brothers and Fidelity National Financial, they could really start to move.
Yeah, to that point, I was just looking at DR Horton, which is one of the big builders, up 18% in the last month, 3.5% uh just today, or 3.4% just today alone. So it definitely looks like that sector is benefiting on speculation about the rate cuts. One of the things that we had talked about with Jacob, who was on here previously, was whether we were running into a buy the rumor, sell the news kind of environment. Rates are well telegraphed, rate cuts are well telegraphed. Do you think that we get a little bit of buy the rumor, sell the news with maybe some of these interest rate sensitive sectors?
Yeah, I think there'll be some of that, sure. Because yeah, it's great if the Fed's going to lower rates, but that doesn't necessarily mean the longer term rates and mortgage rates are going to go down. It will exert downward pressure on them. But we'll kind of have to see what the economy does, and that's an open question. If the economy booms too much, the rates are probably going to stay high. If it's too slow, well, that affects affordability and home demand. So you get a big bump from excitement about the Fed. Yeah, I think a lot of people will sell that news.
You mentioned utilities, sort of being on their own schedule now, and the boom there, where a lot of them are sort of acting like growth stocks because of, the deals with the AI giants, Microsoft and Google and Amazon, to help power all their AI demands. We in addition to utilities, you don't ordinarily think of technology as, associated with dividends, but some of your biggest winners have been tech plays, without giving those away. I mean, are you looking more in sort of this AI era? Are you looking more at technology dividend payers than maybe you were, I don't know, 5, 10 years ago, or is it similar?
Yeah, no question about it. I
Yep.
mean, look, the AI trade has changed everything.
Yep.
And that's where a lot of the big returns are. And, as a dividend investor, I want some too. And, I'm going to focus on those stocks. But, don't forget, no, people don't normally associate technology with dividends, but four of the Magnificent Seven stocks are dividend payers.
Yep.
Are there any other sectors that, utilities, Mag 7, all sort of benefiting from the AI trade? Is there anything else that you're seeing that's maybe emergent, that has an opportunity to outperform, you know, assuming that the background is favoring tech, interest rates probably heading lower, the economy generally holding up, um, stuff like healthcare, like big banks, et cetera. Anything else that really is standing out to you as a direct beneficiary of the backdrop that we're operating with?
Yeah, I think financial stocks.
Yep.
And they've been among the best performers this year for good reason. They thrive when short-term rates, which the Fed controls, go down. So they've been rallying a lot as the odds for the Fed rate cuts go higher and higher. And I think they're in a position to do very well over the rest of the year, even though they've been good performers so far, because they had been dogs for several years with the inflation and the high rates.
Do you have any concerns about them deriving a little bit less of their earnings from net interest income? I know like the yield spreads are sort of are growing, which is typically really good for NII, but I think a lot of the big financial institutions are generating more revenue from trading. Is that something that's even on your radar that is a yellow flag to you at all?
Hey, absolutely. I think you want a pure play on the rate spread thing. You can go with regional banks.
Yep.
They're the most effective, but the bigger companies and the huge money center banks, no question, they have a lot of exposure to market trading. And they've been doing well. The market's been doing well, and I think will continue to do well, even if there's a sell-off this month aside. But I think the interest rate scenario had been holding them back a little bit. So I think while they may not have the most leverage, the big money center banks and the big financial companies, as say an interest rate sensitive regional bank, I think to some degree the rate cuts will take some of the shackles off, and I think they'll go higher.
Last question. We already asked Jacob earlier about his hapless big city, big name NFL team, what his hopes and dreams were for this season. I'd be remiss if I didn't ask you the same as a New York Giants fan. What are your hopes and dreams and your expectations?
Well, I mean the optimistic dreamer's kind of been beat out of me these past 10 years. I mean, I'm looking forward to it.
Yeah.
I think I'm well set up this season because I'm not really expecting anything.
Yeah. Yeah.
So if I get a positive surprise, I'll be thrilled. But I like the long-term situation where the franchise seems to be going. But this year, who knows? They have the hardest schedule ever.
Oh, really? That doesn't seem fair.
Yeah.
Did you know that Brad's hometown has a team too? Cardinals.
Oh, really?
Yeah, he's the fan.
Yeah, they're actually in the NFL. You guys might not know that, but
Where are they now? Ottawa? I thought they were in Ottawa.
never won a Super Bowl. Did win an AFC NFC championship game.
Here's my team in
a
fairness.
century ago. So
yeah, that's right. I remember that Super Bowl. They got there. It was only like what, 12 years ago?
yeah, for them to make it. No, it was 09, 08, 09, 10, somewhere around there.
It feels more like 12 years ago, but
Yeah, I can't keep track anymore.
yeah. Everything to me feels 12. I always say I did that 12 years ago and it ends up being like 15, 16, 17.
Yeah.
I mean, that's probably closer because I had one child, but not two the last time the Cardinals been this. I might not even have had any kids. No, I think that might have been like, oh, wait, that might have been 20 years ago.
Oh, yeah,
I don't know. It all just melts together once you hit
You
your
probably
40s.
couldn't grow a beard back then, right?
I was thin enough not to have to.
Yeah. Well, Tom,
the Bills are looking good. Yeah.
Yeah. But the Bills season, it's simple. It comes down to can they beat Patrick Mahomes? And the answer has been no. Every year, 3 points. They're great. They beat him in the regular season, but not when it counts. And
well, I'm just jealous of playing meaningful games in December, and
yeah, it's been fun. I mean, these are they're not quite the glory years, but the secondary glory years after those 4 Super Bowls. But they'll get over the hump one of these.
Yeah. Maybe this is the year.
Maybe this is the year. We'll see. I appreciate the optimism. But Tom, thanks for joining us, and let's hope that the market remains as optimistic as you are about my Bills.
Okay. All right. Great. Have a great weekend.
All right. You too. All right. Thanks to Tom. Thanks to Cliff. Thanks to Jacob. It's good to have everyone on and touch base. Cliff coming in hot. Gold to 10,000.
That's an episode
I wasn't
title
drinking
right there.
water when he said that. I almost would have spit it out. Man, that's great.
I thought he was going to couch it a little bit and be like, oh yeah, I bet it hits 4,000 end of this year. 10,000 is shot calling. Just coming out of the gates, super super hot. I appreciate
from a guy who just called it 2-3 months ago on here. Gold's going to 4,000, and he's almost certainly going to be right about that. Probably before year's end. He said he thought gold's going to 5,000 before the end of the year. So his bullishness on gold has increased tenfold basically since he was last on. And he usually keeps things pretty close to the vest. So
he is a reserved fellow, I would say, in most cases. So I was definitely not expecting that.
Yeah, I take it seriously when he says that. It made me want to go buy some gold stocks. Honestly,
I might have to up my exposure to gold.
Yeah, exactly. And yeah, good stuff from Jacob and Tom as well. Yeah, really interesting, Jacob, talking about just how quiet things are on the options front, with no sort of consistency. So I guess that really reflects what's happening in the market, which is kind of nothing, which maybe in September is not a hugely bad thing.
But yeah, I mean, September for a month that is historically red is held up fine, right? Like There have been plenty of like panic-inducing or potentially panic-inducing headlines that we maybe should have that the market maybe should have responded to. And even today, it's lower on weak jobs, but marginally. It's not like we're down 4%.
Right. Yeah. I mean, it technically closed at a new all-time high, the S&P by 1 point yesterday. So, a pullback of less than 1% from that is really not much, especially considering, for first week of September, the market was basically flat for the week. That qualifies as a victory compared to what it usually has been the last few years. One last thing before we sign off. We do have a special offer for people for today. Does not involve one of the people who we just spoke with, but nonetheless, Cabot Top 10 Trader, which is run by Mike Santolo, is available if you go to cabotwealth.com/street for half the normal price, $347 for 1 year, save 50%. And you get a 30-day, 100% money back guarantee if you want to just try it out. But it's quite a deal, even in normal times, but especially with half off because it's 10 new stocks every week. Every Monday, Mike delivers 10 of the strongest stocks in the market, complete with the current price, buy range, loss limits, and chart, and where he sees things going. You get access to Mike, and Mike has updates every Friday too. He talks about what stocks that he's recommended recently he still likes. What do you recommends full sell, partial sell to book profits, or what he says you can keep buying. You also get a special free special report how to squeeze an extra 50% profit out of every trade. So again, if you go to cabotwealth.com/street, you get Cabot Top 10 Trader for half the normal price. And we'll have a link to that on our YouTube page. Any last words before we sign off, Brad? What are your hopes and dreams for the Arizona Cardinals this year?
I don't know. Hope they make it to every game. I don't. They're maybe a trendy pick. People like them. I don't know. I think the Seahawks come out on top. I think your Bills are not going to have to worry about Mahomes as much as they're going to have to worry about Bo Nix. So I think
they're becoming too trendy. I think the Broncos are becoming too trendy. Well,
yeah,
let's see.
Probably. I guess the same.
Mahomes is the one team they can't beat. They beat everyone else in the playoffs, at least. They can't beat. I think to beat Mahomes, you have to have a pass rush, and they just never have had enough. They lose by 3 points every time. I think their offense. I think they are better, except they don't have a pass rush. And Mahomes, yeah, I don't know. We'll see. They got one of the Bosa. I think the less good Bosa, so maybe that'll help. I can't remember which is which. Nick? Is it Nick?
Yeah.
Yeah.
Joey's the good one.
Yeah.
I mean, they're both good. I think
Nick,
both really
this was
talented.
5 years ago, it would have been Nick. The answer would have been Nick. Now I think it's Joe. But anyway, thanks everyone for joining us, and have a great weekend, and we'll see you on next week's edition of Street Check.